Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our Head of Research, Jasper Lawler, to discuss the bear market in China, non-farm payrolls and FOMC minutes this week, WTI crude oil at multi-year highs, and an update on Brexit. Before that though, I'll run down some of the top corporate results to watch for this week. It's pretty sparse on the earnings front as we head into summer, but we do have Purplebricks and Superdry reporting full-year earnings on Thursday, and Jefferies Financial Group reporting quarterly results on Friday. As far as UK interim sales results, there's a bit more happening. IAG, Sainsbury's, Associated British Foods and Persimmon are amongst those giving updates throughout the week. Moving on to the economic calendar, on Monday there are manufacturing PMIs released from China, Germany, France and UK, and as well in the US. On Tuesday it's the RBA rate decision and US factory orders. On Wednesday it's US Independence Day, so it'll be quiet there, but services PMIs are out from China, Europe and the UK. On Thursday, it's US ADP unemployment and FOMC minutes, and on Friday, it's US non-farm payrolls and Canadian unemployment. So Jasper, it's a bear market in China.
Yes, so a 20% correction from the recent high. That's the technical definition of a bear market. Whether you want to define it as a bear market or not, clearly the sentiment is very negative to Chinese equities right now. And interestingly, unlike sometimes what you see in the UK, for example, when the currency weakens, the equity market increases. Not so much the case in China. The currency has been very weak as well. The Chinese yuan had its biggest series of declines in over 2 years. So clearly there's some sort of fund outflow from China taking place at the moment. So you can probably lay that at the door of two things. One would be that the economy has been slowing a bit. And two would be you believe that Donald Trump's going to have some success in his trade war and China is going to be negatively impacted while the US positively. Obviously, non-supporters of Donald Trump will be reticent to believe in that second part, but undoubtedly he's shaken things up a bit. And even if there's small change, it probably will be a net negative for China because they have such a big trade surplus to the US right now. Even if it comes down a bit, it's not good for the Chinese economy while they're still trying to transition to more consumer-led. So it seems like assets are coming out of not just China, but emerging markets in general into the US. And you see that happening in other areas of the market too. For example, the small caps. The small cap index is outperforming the large caps in the US. So it's another example of people actually believing that some sort of America first, America belief system is actually going to take hold and benefit the US economy and benefit those companies and assets that benefit from a stronger US economy.
Mm-hmm. Okay, great. And so going on to economic data, we've got Fed minutes and NFP. Would they be the biggest data points this week?
Yeah, I would say they're the big ones. And again, it goes back to this idea of the US versus the rest of the world. These data points can either confirm or deny that idea that the US is pulling away and justify some of those fund flows that we talked about out of emerging markets, out of European currencies, etc. So they are increasingly important, but on the other hand, people are looking at the fact that the US has got a big fiscal stimulus coming in, obviously the tax cuts, potential infrastructure spending, maybe some sort of benefit in terms of the trade war down the road. So putting that all together, people are kind of looking beyond the current sets of data, but clearly, if this data is better than expected, it confirms those ideas that the US is pulling ahead. And obviously we had the Eurogroup meeting last week, and that was another bit of evidence that things are not really particularly politically aligned across Europe. And there's probably, even though it seems like there's some effort to kind of mould policies together, there's not going to be some big fiscal stimulus package from Germany anytime soon.
Okay, thanks. And US crude oil, that's hit its highest since November 2014, but Brent hasn't. What's going on there?
Yeah, so I mean, that's a big deal because it was 2014 when we saw that big price crash in oil. So oil really pushing back up. Obviously not quite at the $100 a barrel level yet, but it's certainly on its way there. But the reason that that spread is narrowing a little bit is that the general thought process is that if it's the US and the White House pushing other countries not to take these Iranian exports, then probably it's going to be the US that benefits the most, and so they're getting that price advantage.
Okay, great. And finally, can you give us an update on good old Brexit?
Well, it's been in the news a bit again, just because the skeptics would say it's Project Fear Mark II seems to be happening. So a lot of big companies, it was mostly European, so Airbus being the first big one, but a few others since, including BMW, but also John Lewis, the head of John Lewis at least, just pointing out the kind of risks of a no-deal Brexit and just all saying, come on guys, we need some indication of what the deal will be, and we absolutely want to avoid a no deal because there's been some push within the Conservative Party particularly to have some sort of plan for what we do in a no deal situation. Obviously that acknowledges the idea that that could actually happen, and a lot of people, particularly in the business community, don't want to see that happening. And I think that sentiment's being reflected in the pound. The dollar strength that we've already talked about, but that Brexit side of things really driving the pound lower, despite a bit of extra hawkish from the Bank of England.
Okay, thanks Jasper. And thank you all for watching. If you wish to get these videos as soon as they're released, please follow LCG on social media.